Welcome back to the channel. In this particular video, we'll be putting on a hedge on our portfolio live. As many of you might know, tomorrow we have CPI day. Who knows how the markets are going to trade? We've seen NASDAQ go absolutely parabolic over the past week or so. A lot of people are waiting for a pullback. Could it be tomorrow? Could it be next week? Who knows? But I want to start preparing for that possible pullback, which is going to happen sooner or later. Now let's look at the charts right now. As I'm talking, the Qs ended up hitting 500 on the dot earlier today, intraday, during Jay Powell's speech, maybe a little bit before that. Right now, it's actually selling off. Is this a perfect opportunity? Is this the sell-off? Who knows, right? Anybody's guess. We did kind of come down here. We ran right back up. I mean, we're currently kind of flat on the day for NASDAQ. If we look on the other hand, the Russell has actually pulled up once NASDAQ has begun to pull down. So there is some sort of rotation here. This could be a healthy rotation. Who knows? But the Qs are breaking to new lows. So you know what? Let's do this. Let's get right into the trade. Now, I normally put together the trades on Thinkorswim just to get an idea of how they look like. What I have in mind, as you might be looking at, is a reverse calendar, some people like to call it. Basically, we're buying a shorter dated option and we're selling a longer dated option. So we're buying the puts that expired about 3 weeks from now, and selling puts that expire about 5 weeks from now. So the ones that are expiring first are the ones we're actually going long on. And this is how the chart looks like. The strike price is perfectly fine right now. Let's just quickly dive into what's actually going on here. So if you notice right off the bat, unlike just buying puts outright or maybe going short the futures, it's possible to make money in both directions here, right? If the market does rally up, you're profitable. If it goes down, you're profitable. If it stays still, you lose money. I mean, but how does that make sense? Why do we make money if the markets go up? Well, that's because even though our put would come close to being worth zero, the puts that we sold, they also come close to being worth zero. And guess what? There's $8 worth of premium there. So we might lose $5 of premium on our long legs, but we gain $8 of premium on our short legs. That is why we're able to make money to the upside through this type of strategy that we're talking about right here. Now, let's take a look. What would it take for us to essentially make maximum profit on this trade to the downside if we want to hedge the downside? You're looking at about 5%, 6%, right? As I toggle here, notice this little dotted line here moving back and forth, 5 to 6%, you have maximum profit on this trade. That's not a crazy pullback. If we go to the charts here, you're looking at about 470 level is what it's going to take to hit max profit, right? So just about here where this gap is, right? This is the move that we're essentially hedging, right? If it drops any more than that, we're not really benefiting from it whatsoever. So this retrace here, which again, if we go over here, this should show us that's about 5.7%, but I'm grabbing off the highs and I'm being willy-nilly where I'm putting the dots, but it obviously should be 5%. So that is what we'd be covering with this particular hedge. Now to the upside, if we, let's say, do not want to lose money on putting this hedge on, it would require about a plus 2% move. Notice that if I toggle this back and forth, it moves back and forth and it's just under 2%. That's all it takes, 506. We get there, it's a break-even trade. Now, the purple line represents the date that is over here. This is a 1 week before expiration. We do not want to hold this into expiration. Notice how deep those losses can get, okay? We don't want to hold till that final week. We're going to hold it until a week before, which is about July 19, which means this is for 2 weeks. We're putting this hedge on for 2 weeks. If price stays exactly where it is of the Qs, as it stands right now, of this particular sizing, 50 contracts, we would be down about $4,000 on this trade. If it goes down just a little bit, goes up a little bit, we'll be down less on it, right? And we've already covered the zones as to when we'd be at break even and when we would be profitable on this trade. It wouldn't take much to be break even on the downside, by the way. You're looking at about also just over 2% move. So 2% on both sides to be break even. Over the next, well, in this case, let's say 2 weeks. We want to get out a week prior. We don't want to hold for this massive, pullback. I mean, this is a $20,000 maximum loss, by the way, in the middle here. Now, things are not as simple as it looks. Let me look at the charts. Let me just also see what Qs are doing. Okay, they're still at their lows. Okay, I just want to make sure the market's not going to start dumping 3% in front of us as I make this video. Now, As I say that, here's the tricky part, or here's what can change this graph around. The change in volatility to each leg. Right now, the volatility for each leg is at 15% and about 16%. Normally speaking, when the markets do begin to pull back and when there's a crash, you do see an influx of volatility into the shorter dated option. People tend to rush into whatever gives them the most gamma exposure right off the bat. In simplest terms, gamma exposure is price exposure. You know, if the markets were to drop 1% more, you obviously want to make as much as you can from that. You're not going to buy options that expire 1 year from now if you're trying to hedge for something that's happening this exact day or week, right? You're going to buy the options that are most sensitive to the price movement that is happening today, which is why that demand for those options pumps the implied volatility of those options. So normally speaking, we're going to see implied volatility on the shorter dated options go up in times when there's a sell-off and people are rushing to buy these puts. Now notice what happens when I change the implied volatility per leg here, right? As I take and I increase the long leg by 5%, notice that the purple line ends up poking up. Impossible to lose money by July 19, right? That's what it actually shows. If we reset it, you can see what it looks like, right? But that's not going to happen. Obviously, if the long leg goes up by 5%, the short leg will also go up by an amount. Now, if it also goes up by 5%, the P&L looks even worse. Why is that? Well, there's more premium in the short leg. So that whole leg, all that premium gets affected by this 5% point raise, which is why we can't have that happen, right? That's the risk you take on. Typically speaking, that shouldn't really be happening. If that goes up by 5%, let's say this goes up by 3%, so it will look something like this. So maybe it still turns out to be a wash for us. So as you can see, you know, it's really hard to rely on what the chart will look like when things start moving around, simply because, again, you know, implied volatility will change things around a lot. Now let's reset that. We're still going to be putting this trade on. I've agreed to put about 50 contracts each. So on the maximum side to make about $15,000. But again, that can change depending on what the implied volatilities kind of end up doing, especially for that purple line. But either way, we will put this trade on. I will bring up interactive brokers for us right now. There's the queues. Let's go to new window. Let us go to the option chain. The option chain, let me just verify. I'll bring this probably off screen for a split second as I look at the option chain, as I just simply make sure I have the right ones opened here. We're looking at July, those are July 26s and August 16th. Okay, I'll just bring this over. And we're looking at the 495s. Okay, so the 495s, July 26 and August 16. We can see 17 days, 38 days, so about double the distance. We're gonna actually grab the 495s, the only ones available on both dates. Let's grab and we're gonna buy here. Oops. Okay, let's try that again. Let's click on option chain. Let's click on strategy builder. Let's go to 495. Let's make sure we buy this one. Let's go to here and we're gonna sell that one. Okay, so we're buying the August 26s. We're buying the July 26s, selling the August 16th, 495. We could see that the market is around at 409. Let me just make sure everything matches up here as well, right? We are collecting a credit. So over here, we can see that, you know, it's pricing at around $3, but I don't believe that's the midpoint. But it is a credit because, again, that leg that we're selling is worth a lot more, right? We can click on the profile here, but it's not as, you can't see as much as you can see on Thinkorswim. That's why I normally use Thinkorswim to put the trade on. Okay, so I just verified this is the correct options, the correct legs. We're gonna be using 50 contracts, as I said. Let's hit the mid price and let us submit the order. We're gonna click right here. I'm gonna send that off to the market. Click away from it. We can kind of see it's currently a working order. The mid price dropped a little bit. We can maybe, let's say it's about 2 cents less. They're making us take, let's go down penny, see what happens. They still do not want to give it to us. I'm just seeing what the market is doing as I speak. Market's kind of trading a little higher. Market is trading a little higher at the moment. Let's go down to, so I just want to get filled for the sake of the video, and that is that we got filled on this trade, 50 contracts. And I'll keep you guys updated on how this hedge goes and how the position plays out, because again, the implied volatility will obviously, you know, move around that graph quite a bit. I do want to say that you do have to have a portfolio margin account to be able to put this trade on. Otherwise, reverse calendar trades are not allowed. Simply because with regular T margin, they usually see that the long leg expires before the short leg, and because of that, they require a lot of margin to put that trade on. But with portfolio margin, they look at it in a different way. So you don't have to worry about that. So it's not as margin intensive as it would be on an account that is not portfolio margin. But that is it. I put the hedge on, so if the markets do end up dropping, a good bit, I should be able to pocket about $15,000. Again, how implied volatility plays into that, we're gonna have to see. I do expect the short legs to go up a lot more than the long legs, but I'll keep you guys updated on how things proceed. If this was informative, if you have any questions for me, just leave them in the comments below. You can also like this video and subscribe. Other than that, thank you so much for watching, and good luck out there.